Today we're talking about VUSA not as a ticker, but as a strategy. Because when you buy VUSA, you're not betting on a company, you're betting on the long-term success of American business as a whole. Most people try to beat the market. VUSA is about becoming the market. Pushpin, what VUSA really is. VUSA is the Vanguard S&P 500 UCITS ETF. It tracks the S&P 500, the 500 biggest companies in the US. But here, the key, those companies aren't just American, they are global. Apple sells phones worldwide. Microsoft runs cloud systems for businesses on every continent. Amazon delivers to dozens of countries. So when you buy VUSA, you're not just buying America, you're buying global business power headquartered in the US. VUSA is physically replicated. That means Vanguard actually buys the stocks in the index. No tricks, no synthetic swaps, real shares, real companies. Money with wings cost, the silent wealth killer. Fees don't scream, they whisper, but over decades they become huge. If you invest £300 a month for 30 years, at 0.07% fees, you keep most of your returns. At 1% fees, you lose tens of thousands to fund managers. VUSA's low cost is one of its biggest advantages. You're paying Vanguard, not a high-paid stock picker. Chart increasing how returns really happen. People think returns come from price going up, but there are three drivers. Company profits growing. Investors paying more for those profits. Dividends being paid. The S&P 500 has grown because businesses innovate, expand, automate, and dominate new industries. VUSA rides that wave automatically. But growth is messy. You will see crashes, you will feel fear. In 2008, many investors sold at the bottom. In 2020, markets fell fast, then recovered fast. Long-term investors who stayed invested were rewarded. VUSA rewards patience, not prediction. Warning: the risks most people ignore. Market crashes are obvious, but here are quieter risks. Political risk, changes in US taxes, trade, or regulate. Technological disruption, today's giants may not lead forever. Valuation risk, if stocks get too expensive, future returns may be lower. Currency erosion, if your currency strengthens versus USD, your gains shrink. VUSA doesn't avoid risk, it spreads it. Concentration, 500 stocks, but not equal. Although there are 500 companies, the top 10 often make up around 25–30% of the index. That means your returns are heavily influenced by a handful of giants. If Apple sneezes, VUSA catches a cold. This isn't necessarily bad, but you should know it. Money bag, dividends, payday or compounding. VUSA pays dividends. That's nice, but it also means compounding is your responsibility. If you spend the dividends, your growth slows. If you reinvest them, your growth accelerates. That choice matters more than most people think. Jigsaw: how to build a portfolio around VUSA. Think of VUSA as the engine, but engines need wheels. You might add a World ex-US ETF for global balance, an emerging markets ETF for growth, a bond ETF for stability, a small cap ETF for innovation. VUSA is powerful, but it shouldn't be lonely. Brain psychology, the real battle. The biggest enemy of VUSA investors isn't the market, it's emotion. People panic sell. People chase hype. People buy high and sell low. VUSA only works if you stay invested when it feels uncomfortable. The winners aren't the smartest, they're the most patient. Direct hit: who should buy VUSA? VUSA is for long-term thinkers, busy people who don't want a stock pick, investors who value simplicity, people who understand volatility, It's not for day traders, get-rich-quick thinkers, people who panic easily. Checkered flag. Final thought. VUSA isn't exciting. It won't make headlines. It won't make you famous. But over decades, it has the potential to quietly build wealth, one boring, powerful year at a time. And in investing, boring usually wins.